Financial scandals have shaken global markets, destroyed corporate empires, and led to sweeping regulatory reforms. From fraudulent accounting practices to large-scale Ponzi schemes, these cases offer valuable lessons for businesses on governance, compliance, and ethical decision-making. Over decades. Madoff promised consistent, high returns with little risk, but instead of generating legitimate profits, he used new investors' money to pay earlier ones. When the scheme collapsed in 2008, thousands of investors, including major banks, charities, and individuals, lost everything. Lessons learned. 1. If an investment sounds too good to be true, it probably is. Businesses and investors should be skeptical of guaranteed high returns. 2. Due diligence is essential. Madoff's fraud went undetected for years because investors failed to verify how returns were generated. 3. Regulatory oversight must be strong. The SEC received multiple warnings about Madoff but failed to act. 3. Companies should support rigorous compliance reviews to detect fraudulent schemes early. Volkswagen emissions scandal, 2015. The cost of ethical failures. Volkswagen, VW, one of the world's largest automakers, was caught installing software in diesel cars to cheat emissions tests. This allowed vehicles to pass regulatory inspections while emitting up to 40 times the legal pollution limits. The scandal resulted in billions in fines, executive resignations, and reputational damage. Lessons learned. 1. Short-term gains don't justify ethical compromises. VW's deception helped boost sales initially, but the long-term damage was far worse. 2. Regulatory compliance is not optional. Businesses must ensure that products meet industry and government standards. 3. Corporate culture matters. Employees followed unethical directives because they feared retaliation. Wirecard, 2020. The importance of external audits and transparency. Wirecard, a German fintech company once valued at $28 billion, collapsed after it was revealed that $2 billion in assets were missing. The company had been fabricating financial data to inflate revenues and mislead investors. External auditors failed to catch the fraud for years, and regulatory authorities were slow to investigate. Lessons learned. 1. Auditors must be truly independent. Wirecard's external auditors overlooked red flags, highlighting the need for strong audit oversight. 2. Internal fraud detection systems are critical. Companies must regularly assess their financial statements, transaction records, and internal controls. 3. Regulatory vigilance must be proactive. Delays in investigating fraud allowed Wirecard's deception to continue longer than it should have. 5. FTX collapse, 2022. The dangers of poor corporate governance. What happened? FTX